Hello, everybody. Thanks for joining this broadcasting from CoreShares. My name is Gareth Stobie. I head up the CoreShares business. CoreShares is a contemporary asset manager focusing on the world of passive investing and index investing. We follow an evidence-based investment framework, which is something I'm going to take you through as part of this presentation. Investing is often criticized for its complexity and being inaccessible to the layman in terms of how we approach things and the language we use. So today I'm going to try and simplify things, and I'm going to take an approach in a presentation that I've entitled Minimizing the Moving Parts Through Indexing. We live in a very noisy world, and how do we distill a lot of things that go around us and really focus on kind of what's important. First of all, I'm going to just talk about the ecosystem that we operate in, because I think, as always, there's change about. So certainly from a client or end investor point of view, there's a lot of responsibility placed on clients today to ensure that their investment affairs are in order, particularly as we've moved from a defined contributions environment to a defined benefit environment. And we also know that people are living longer and that careers are changing and are different to times gone by. So the world through a client's lens has changed significantly. In terms of financial advisors, how the financial advisor profession looks today has also changed. Whereas before advisors would sell return and sell kind of who the next star fund manager might be, today it's much more focused on ensuring that clients meet their goals and that clients stay the course. At CoreShares, we often quote the paper by Morningstar entitled Gamma, which really hones in on the value of advice, ensuring that clients are on the right tax wrapper, that their choice of assets are meeting their liabilities, and so forth. And then from an asset management perspective, asset managers can no longer operate in a bubble. They need to be way more client attentive, ensuring that what they do really helps clients meet their particular goals. So asset managers are becoming more solutions orientated, and indexing is playing a big role within that context. So these are the three kind of key stakeholders in a money relationship. You have the end client who has a set of assets and goals that they're looking to fulfill. You have advisors who are holding their clients' hands, helping them try and reach that goal. And you have asset managers who are managing the investments and trying to provide solutions for those particular clients. So let's look at one particular problem and how we can try and start chiseling down the problem and distill it into its simplest form. So if we take a classic retired client, and this is someone who I was just mentioning, has perhaps moved from defined benefits. When they were younger, they probably thought their company would be paying their pension in retirement. Now they're responsible for it. There's someone who worries about how long they're going to live for, and they're consumed by making sure that their little nest egg will last them, that they'll be able to draw a reliable income, that income will keep up with inflation, that it won't be lost, and so forth. And if you look at really what they need is a reliable income. They need their capital to be protected, and they need their income to keep up with inflation. There's no point in having income that doesn't keep up with inflation through time. So if you distill what's on the minds of most retired people, this is what they're looking for: income, capital protection, and inflation protection. Now on to how one approaches this investment problem. And this is sort of the topic of my talk, minimizing the moving parts. If we look at it, there really are certain aspects of an investment process where we know what we're working with. There are the controllables, so to speak, and then there are the uncontrollables. Those elements that dominate the headlines of newspapers that are actually pretty unhelpful in terms of putting together an investment solution. We don't know, for instance, how the next American elections are going to play out. We don't know whether there may be a particular company failure around the corner that we hadn't anticipated. There's certain aspects that are uncontrollable, that are speculative. What we're going to do today is focus on the controllable aspects, the aspects that are grounded in evidence, that are evidence-based, and here are some of them. So first of all, you have asset allocation. Should one decide to invest in equities, bonds, property, cash, or if they're going to invest in a collection of those, in what ratios make sense given a particular goal? So setting your asset allocation is very much within your control. And setting that in a strategic framework is also within your control. Diversification is in your control. One can decide from the outset whether you're going to invest in a portfolio of 50 stocks versus a portfolio of only 20 stocks, and whether you're going to invest across asset classes or in just one asset class. And lastly, fees are controllable. We can choose today whether we're going to invest in a low-cost fund or in a high-cost fund. So using these controllables, using aspects of the investment process that are backed by evidence, we're going to try and solve the retirees' problem of income, capital protection, and inflation protection through time. So let's start with asset allocation. Today, across markets, we have deep research in terms of what one can expect from asset classes through time and how those asset classes interact with each other. We know, for instance, that investing in the equity market carries with it very good returns over the long term, and I emphasize long term, but can be volatile in the short term. Whilst cash and bonds, for instance, can yield slightly lower returns, but are much more stable in terms of their return profile. And then, of course, there's the correlation between them. Bonds might be up whilst equities are down, equities might be up while bonds are down, and so forth. So using very long-term data, we can put together a portfolio focused on a goal. And I'm going to define the goal for the retiree as inflation plus 3%. We can package together a solution using the long-term data from these asset classes that provide for the highest level of predictability that a retiree is going to meet the inflation plus 3% target. And we can set that strategically and then hold the course through time. Very often people are asked but shouldn't we be adjusting our bond exposure given certain market circumstances, or going offshore in this environment or onshore in that environment? And the reality is that tactically asset allocating between, say, bonds, equity, cash, offshore, etc., is very difficult to do. We don't know tomorrow's news. So we have found through our research that managers most of the time are actually better off sticking to a strategic framework rather than tactically asset allocating across these different asset classes. By sticking to a strategic framework, we found that their predictability in terms of meeting that inflation plus 3 benchmark improves materially through time. So strategic asset allocation is something that's controllable. Tactical asset allocation is not something that is grounded with a lot of evidence to support it. It's a very difficult thing to get right. So asset allocation is in our control and is an important part of the process. Next is we're going to look at diversification, another part of the controllable aspect. And we know that equity, for instance, within the overall solution is a really important part of any solution. And why is equity important? Equity is important because it has the highest probability of outperforming inflation through time. So 90% of any 7-year rolling period, you can expect equity to outperform inflation, whilst bonds only 75% of the time. If we add the 3%, which is our real goal, so inflation plus 3%, equity still outperforms that by 62% of the time, yet bonds is only 36.9%. So whilst it might feel uncomfortable some of the time to hold equities over bonds in an income solution, equities remains a very, very important part of maintaining a client's purchasing power over the longer term, and why we advocate for a generous allocation to equity within a portfolio, and why there's a strong emphasis around the equity block of any solution. So looking at diversification within the equity market then. One of the simplest yet most effective risk management frameworks that's come to market in the indexing space is to simply cap indices so that you don't have exposure to any very large shares. So what we've done here is shown the top 40 index relative to the S&P top 50 index. The S&P top 50 index caps the largest share to 10% and then reweights the portfolio across it. So you can see there the light blue line is cut all the way down to 10%, and then the balance of that weighting across the index. So what that effectively does is it makes sure that you don't have too much exposure to the very large caps in a particular index. Indexes in South Africa are often criticized because of the concentration risk, and this really improves that and improves diversification, which is one of the things that we're trying to achieve. So capping is the very simplest form of risk management. It improves diversification. But hang on, doesn't reducing exposure to the mega caps mean that you might be missing out on return from some of those very large companies? And interestingly, you don't. So over time, we see that the top 50 index, which caps at 10%, actually keeps up with the top 40 index through time. So one has improved diversification through a capped index, yet there hasn't been a compromise in return. So index construction, index design is important within this context. Then I'm going to move on to some of the innovation that has happened within the indexing market. Today, indexes can provide lots of different types of exposure beyond simply mapping the market based on company size. The term smart beta is now become fairly well understood, but really relates to indices that are built in a way that is not simply market cap. So what we've looked at is to say, well, can we find an index design that is more closely aligned to the goal that we're trying to achieve? So the goal, remember, was income, capital protection, and inflation protection through time. And you can see here that the share on the left, stock A, which could be, say, a bank, for instance, has got a very stable dividend that grows through time, and a share price that sort of more or less tracks that dividend growth through time. So this would be a share that we would want to have in the portfolio because it's very closely aligned with the goal of a growing income stream through time. Whilst the share on the right, stock B, is very different to that. This might, for instance, be a mining company that's got very volatile earnings and therefore very volatile dividend. This would be a less desirable share in terms of trying to meet the client's a goal of a reliable growing income. So today you get dividend strategies that focus on the sort of stocks that are included as stock A. And we run a strategy at CoreShares known as the Dividend Aristocrats Index, which buys and holds shares that have paid, maintained, and grown their dividend through time. And this sort of strategy has been shown to perform really well relative to all of its peer groups. It's been able to outperform 96% of its peers in terms of the income that is able to generate from the equity component of the portfolio. So smart beta is important within this context. Smart beta is also important in terms of another aspect of the goal, and that was capital protection. Now we know that we know that equity can be quite volatile at certain times. And so what we've taken a look at here is the global financial crisis of 2008. And we see, for instance, that over that time period, the top 40 fell by 43%. The dividend aristocrats also fell quite sharply, but only by, say, 33%. So some 25% less than the top 40 index. So still volatile, still equity, but major downside protection in terms of how it performed. So using smart beta and using these different index designs within the equity buckets, we're able to more closely align the investment proposition to what the client is looking for. And then the last part of the evidence equation is cost. We know how important cost is because cost is known. It's a structural thing that impacts fund returns. And what we did in this particular exercise is divided up the CISA low equity category between the high cost funds and the low cost funds. And we found that funds with a higher total expense ratio in the first bucket had a much lower consistency in its ability to outperform the goal of inflation plus 3%. So only 25% of the time did it outperform, yet lower cost funds with the lower TR were able to outperform 46% of the fund, 46% of the time. So just simply moving from high cost funds to low cost funds, one's probability of outperforming the benchmark improves materially. So what have we tried to do here? We've tried to solve the goal. The goal was income, capital protection, and inflation protection in a way that actually was quite humble. We didn't try and say, well, we can predict the future. Rather, what we tried to do was, let's work with things that we can control, that are under our control. And we approached that in a mechanical way, using all of the very best index technology. So controlling for single stock risk in the capped index, aligning the income goal through smart beta, through the dividend aristocrat strategy, keeping costs low, keeping a strategic asset allocation that we know would meet that long-term goal with a high level of predictability, and then not tactically allocating around that, thinking that we would improve the outcome, because there's no proof that we'd be able to do that. So the goal ultimately was met through the systematic, mechanical way, and that's how we've tried to keep it simple and work with the evidence. Thank you.